Good morning and a good afternoon to everyone who's joined in. We welcome you to today's webinar which is titled Building Stronger Partnerships and How to Manage Third-Party Risks for Business Success. So in today's interconnected business landscape, third-party relationships are becoming increasingly critical to organization success. However, managing third-party risks is a complex task that requires careful consideration and proactive measures. And in this webinar, we will be discussing the importance of effective third-party risk management, exploring best practices and strategies, and share some real-life examples of how organizations have successfully navigated this challenge. We will have today with us Mr. Neil Isherwood from our Dun Bradstreet United Kingdom office, who will provide us with our valuable insights and expertise on this topic as well. I hope that you will find this webinar informative and valuable. Please feel free to ask questions throughout the session. So let's get started. Let me first start off with introducing Neil. So Mr. Neil Isherwood has over 20 years of experience in the information industry, working with customers to help improve their data using integration technology and hosted solutions. Majority of his experience has been in the financial services, specifically within AML and KYC, where he has worked to understand clients' challenges, monitor shifts in the regulatory landscape, and find ways to enable practical use of data and technology that enhances the customers' and supplier due diligence processes. In addition to Neil, myself, my name is Noman, and I am the Group Director for Enterprise Solutions at Dun Bradstreet, South Asia, Middle East, and Africa. Some housekeeping items before we start off. So this webinar is being recorded and all lines are muted by us at this point in time. Please submit your questions or your queries or concerns that you may have for any issues of the webinar in the chat window. But for any questions that you may have during the content that is being covered, please use the Q&A box of the Zoom webinar. And on the LinkedIn Live, we do have a team which will pick up the questions from there as well, if they are posted any. If you want, you can raise your hand using the Zoom feature, and we will unmute you where you can speak up and share your questions or challenges that you may have. After this webinar is over, we will be sharing the recording with you as well. If you would like to speak to any one of the speakers, myself or Neil, after this webinar, then please do note down this email address. It's marketing@dnbsame.com. You can use this email address to reach out to us and have a further conversation if you do so require. For today's session, the table of contents that we do have, the areas that we'll be covering are the evolving threat landscape. Then we'll dive into what does a good risk management program look like. Then we'll go into seeing the implementation of the risk management program. And then we look at the strategies for effective risk management. And we do have a solution provided by Dun Bradstreet for this purpose called Risk Analytics, Compliance Intelligence. If time permits, we will cover this in a little bit of detail. And then, of course, we'll dive into a case study and some real-life examples, if time permits again. And then, of course, we'll give ample time to Q&A if you do have any specific questions towards the end of the webinar, which have not been covered during the session. So let's start off with a poll, and this should start coming to you now. And this should be on your screens as we are speaking. So the question is, what is your organization's biggest risk management challenge? You can choose either one. I can see some people have already started responding. I would request others to participate as well. So is it identifying risk? Is it assessing and prioritizing risk? Is it implementing risk controls? Is it monitoring and viewing risk? Or is it communicating risk to the stakeholders? I can see a lot of you have started to answer this already. I'll give you another 10 seconds for you to respond, and then we will switch off the poll and show you the results as well on the screen. Okay, I think we can pause now, and thank you for your participation. What I'm going to do now is to share the results on the screen, which should be visible to you now. So we can see that there generally is an even split between the answers that have come up. That is that all of you have said that identifying risk, assessing and prioritizing risk, implementing risk controls, or monitoring and reviewing risk are key concerns at your end. So there's an even split between those responses. And towards the end, we do see some of the respondents also letting us know that communicating risk to the stakeholders is also of challenge as well. Okay. So let's now go back and start off on the webinar and go on to our first topic, which is the evolving threat landscape. And this is where I'm going to rope in Neil and ask him to, and thank him for joining the call today with us in the morning, and ask him what are some emerging trends in the third-party risk management that organizations should be aware of, and how does Neil see the landscape of the third-party risk management evolving in the coming years as well, given his experience. So Neil, over to you.
Thanks, Nauman, and similar good morning, good afternoon to everybody. And yeah, I think from our perspective, mainly in the UK and Europe, we see that overall regulations are just constantly increasing. And along with this, the expectations of supervisors and regulators is also being raised. And also as new technologies and best practices emerge, we find that businesses really are under increased pressure to evolve and improve their policies and systems as well. And on the screen here, we've called out 4 main areas that we see big changes in. So first of all, the AML, the anti-money laundering and know your customer landscape, this is changing all the time, because as criminals find more methods to launder illicit funds, then the regulations have to keep playing catch up to include these risk typologies in their guidance. And from a European perspective, we've seen a lot of changes recently. The old money laundering directives have now evolved into a wide-ranging package, including new AML directives, and also a certain portion of those rules have moved into regulations. And if you're not familiar with Europe, the difference between directives and regulations, a directive allows each country a certain amount of flexibility as to how they implement those rules into national law. And what they found is that resulted in inconsistencies in each member state's approach, whereas regulations don't have that flexibility. So each country must adhere exactly to the rules. So these changes were brought in to ensure a much more harmonized approach across the whole EU. And this package also saw the creation of a new European super regulator, AMLA, or the Anti-Money Laundering Authority, and they will directly supervise around 40 of Europe's largest multinational financial institutions. But obviously, it's not just Europe where these changes and regulations are increasing. Globally, countries are committing to implementing the Financial Action Task Force recommendations. So we will see the same themes and requirements come into play around the world. And then moving on to the next few here, from a sanctions perspective, we've seen numerous rounds of updates driven by the Russia-Ukraine conflict, and these can be quite hard to keep up with because sometimes there's only been a gap of maybe a few months between revisions. And also supply chain is becoming a much bigger issue, with the wider ESG topic becoming a key imperative for many firms. And finally, data privacy is consistently making itself known in the background. And we're going to talk a little bit more about the last 3 areas over the next few slides. Okay, so one of the areas that can enable risks, or I guess more accurately to the point, hide them, is obscured beneficial ownership. And there are numerous examples of where hidden ownership has caused or at least enabled all manner of issues, such as tax evasion, sanctions, money laundering, etc. And organizations such as the OECD, the Financial Action Task Force, Transparency International have all called out that having transparency around who owns a business is crucial to combating crime. And we can see on the screen here, there's multiple examples where bribery and corruption has been enabled by channeling through shell companies with opaque ownership structures. And I'm going to hand over back to Nauman now to cover some of the specific issues seen in the Middle East region.
Absolutely, Neil. Thank you so much for that. And we do see some similar issues within South Asia, Middle East, and Africa as well. And as we'll be seeing on the screen now for the participants, there are various issues there. For example, we do have the FATF or the FATF grey list, where Lebanon will be probably getting included because of unsatisfactory practices to prevent money laundering and terrorism financing activities and implications which are there. We do also have regulatory compliance risk from a Nigeria perspective, as an example, where Meta was fined over $200 million for violating consumer and data laws within Africa. Then, of course, we do have other African examples of Mozambique as well, of debt scandal charges that have been there. Or we look at, let's say, Bangladesh as an example, where there are sustainability or ESG risk from a global fashion brand exploiting Bangladeshi workers and those kind of areas which have been covered as well. So those are some of the issues that we wanted to highlight at our end, and maybe also towards the end, also talk about maybe the supply chain risks which are there within the Middle East, the tensions which are there. And that is leading to diversion of, let's say, lengthier and costlier maritime routes, right? So we can see on the screen where a simple trade route from the Red Sea could take about 19 days, and alternate routes via the Cape of Good Hope is now taking over a month to cover that same distance and to be able to cover that same route. And so those risks will keep evolving, and we need to keep sure that all of these do get impacted in our day-to-day lives of businesses. And this is where all of these conversations will tie up together as well. Neil, I'm going to hand it over back to you to be able to talk about the sanctions and the beneficial ownership.
Thanks, Nauman. Yeah, so focusing in on the sanctions just for a moment, the hidden ownership is really being recognised as crucial now in terms of sanctions enforcement. So in the UK, the Office for Financial Sanctions Implementation released some guidance on how it will view a company's compliance programme when looking at enforcing penalties for any sanctions breaches. And there's an entire section within this document that covers the due diligence that is expected around understanding the ownership and control of an entity that you're dealing with. So this calls out that if your program does very little in this regard, then it will be considered an aggravating factor. And equally, if your program is well structured and you do as much due diligence as practically possible, then this will be a mitigating factor. So we can really see that understanding ownership is a real key aspect to any due diligence program. And also, I think what we see is it's still a common misconception that sanctions are only relevant for the financial sector. And on screen here, we do see a fine for a payments company that made transfers into Russian bank accounts. But then we also see a telco company, Telia, who got fined for facilitating calls to Syriatel. And finally, we see a subsidiary of Johnson Matthey, Tracerco, and they make measuring products and services to the oil and gas industry. So you can see it's not just banks that need to worry about this. Sanctions apply across the entire industry spectrum. And then more recently, as mentioned, there's definitely been a heightened focus around the Russia-Ukraine situation. And we've seen instances now where some European components are still being found in Russian drones and missiles. So clearly this is not going to look good for a company to have these parts exposed in news stories. So overall, I think sanctions evasion has really become elevated in its importance. And definitely in the UK and Europe, we've seen a lot of companies really realizing they need to overhaul their existing controls. And it's definitely resulted in a big influx of work from us at a D&B perspective. And now I'm going to hand over back to Nauman, who's going to talk around the data privacy and breaches.
Absolutely, Neil. So we just look at a small study, just want to bring it to the attention of the audience here. And PwC does this study every year for the Global Digital Trust Insights. And this year, the Middle Eastern respondents were just under shy of 50, about 48 respondents within the Middle East. And the question that was posed to them was thinking about the most damaging data breaches that have taken place in their experience in the last 3 years. What has the cost been for these organizations to deal with such disruptions, right? And we can see, starting in the first box on the left, that 19% of the Middle Eastern respondents estimated a cost of about $1 million to $9 million, and so on. If you go to the middle one, about 8% of them thought that the cost that got impacted to their organizations about 10 to 19 million, and about 2% had predicted the cost to be in excess of about $20 million. So we can see that globally, the percentage of organizations reporting $1 million or more in cost that has risen because of data breaches or lacks of regulatory compliance is rising about 36% from 27% last year. So that's something I want to bring into perspective from a Middle Eastern market perspective as well, that these kind of issues have been prevalent everywhere. And now, Neil, I'll hand over back to you to cover probably the human rights and environmental due diligence trends globally, which are taking shape.
Yeah, thanks, Nauman. And this is an area that's been steadily growing, I think, in terms of importance. So the wider ESG topics around human rights, modern day slavery, etc. And we've seen that consumers have been raising their expectations for many years about what they expect from large corporations. And this has had a knock-on effect of companies looking towards implementing best practices and trying to obviously avoid any issues surfacing that could cause significant brand and reputational damage. And this has increasingly become, I would say, more solidified with varying sets of regulations. So you can see on the slide here that many countries now are starting to introduce regulations around these areas. In Europe, Germany passed the Supply Chain Due Diligence Act, and this has now been broadened out into CS-DDD, which will cover all of Europe. And CS-DDD will actually have a reach further than I think a lot of people anticipate at first. So this was voted in on the 24th of April this year, and it has requirements to conduct due diligence all the way through the supply chain to identify any adverse human rights issues, along with environmental impacts. And then it places the responsibility on the company to eradicate or at least mitigate these. And then they've got to report publicly on what they're doing and how effective it's being. And this is going to be phased in over a few years. So on the pyramid on the top right there, we can see that 3 years after implementation, the most largest companies with over 5,000 employees or 1.5 billion in sales will be in scope. And then as we move through 4 years, 5 years, it starts to move into down the employee chain and look at smaller companies. So ultimately, after 5 years, any company with 1,000 employees or 450 million in sales will be in scope to do this. So at first glance, you might think this won't impact you, unless, of course, you fall into one of these categories. But we've got to remember that although this act applies to the larger companies, their supply chains will flow down into a number of medium, small, and even micro businesses. And obviously those supply chains can go anywhere in the world. They're not just constrained to Europe. So I think we'll find a lot of companies will be impacted indirectly because these large companies will be asking for much more detail, for more clarity on the policies throughout all their suppliers, and they'll want those smaller businesses to also adhere to standards of the larger organizations.
That's right, and thank you for that, Neil. So may I then request you to also cover and to be able to also talk about what does, in your view, what does a good risk management program look like, and for SMEs and micro and smaller businesses, how does one go about it, and what are the key components in your view that could be added?
Yeah, absolutely. So I think when someone or a company is looking at a due diligence process and what that entails, I think first of all, we have to zoom out a little, and we also need to understand the context of where that due diligence and risk management sits within a company's compliance program. So that due diligence process should not really feel like a standalone part. Really, it should be wrapped and guided by the corporate objectives. So first of all, it might sound like a little silly question, but what are the objectives? How has your organization framed the risk management? Have they positioned it as truly looking to minimize risk and do the right thing? Or has it been positioned as a cost center or a barrier that just needs a tick in the box? So to then move into what does a good program look like, and wondering where to start, well then one of the documents that we're going to concentrate on today is the UK Bribery Act Guidance. And the reason for looking at this document is it simplifies the program into 6 key principles. So first of all, on screen, we've started with due diligence, because I think that's where a lot of organizations start to look first. How do we get a handle on risk? And obviously at a high level, this document then says you need to apply due diligence procedures, and you have to take a proportionate and risk-based approach, looking at both people and businesses that are going to perform services for you or on your behalf. And although this document keeps calling out bribery risk, these principles really apply equally to any of the emerging threats that we've covered today. So that's where due diligence sits. But then if we kind of look at the wider context, then the first principle is proportionate procedures. So this is where it's saying that your organization should have a program that's proportionate to the risks it faces, and taking into account the complexity, the types of activities that your business does. Then the next one is quite key. It's about top level commitment. So it really says that the senior management of an organization, whether that be the board of directors or the owners, they have to be committed to preventing bribery or any of the other risks that have been identified, and that they need to foster a culture within the organization where bribery or other risks are not acceptable. And then we have risk assessment. So again, it's touching on making this a risk-based approach, looking at what you're exposed to. And also this part says that this assessment shouldn't be done once and then forgotten. It really should be reviewed periodically, because obviously risks change and the threats to your business change. So it needs to continue to evolve. And then we saw that's where due diligence sits in. And then after that, communication is really key. It's got to be pushed out around the organization, both to internal people and also external communication. So the third parties and perhaps your supply chain that you're dealing with, you've got to be able to communicate why you're doing it effectively. And then the last principle is monitoring and review. So again, they're effectively saying, don't just put this in place once and forget about it. Keep looking at if this guidance, if this policy is actually performing. So I think from my perspective, these are the key 6 principles, and we can see where due diligence sits into this. And there are lots of documents out there similar to the UK Bribery Act. The US Department of Justice actually put out a paper specifically saying how it will assess corporate compliance programs. And no matter which piece of guidance or documentation you look at, they all tend to have the same key themes. So it's starting with assessing your risk. So you can't mitigate risk if you don't actually know what your risks are. And then the business and senior management have to decide what's your risk appetite, because that will then in turn feed into the due diligence program, and that can guide you as to how much time and effort you expend on different types of third parties. So you can design controls to mitigate risks, but you can't eliminate risks altogether. So this is where that proportionality and the key phrase is a risk-based approach comes in. Because if you put a really strict standard across everyone in your supply chain, then resourcing that program is going to be difficult. And it's likely that the sheer volume of work that you're going to generate, if you maybe have tens of thousands of suppliers, then really the bigger risks can get lost in the noise of that. And then obviously, once you've gone through those steps, you can then look at the actual implementation of that program. But really, the key theme here is this should be driven from a top-down senior management commitment to doing the right thing. It shouldn't feel like the program is orphaned.
Absolutely, and thank you for that, Neil. So let's now dive into, and this is great, right? Because we're talking about senior management representation, we're talking about the continuous reviews as well. So I think this is the best time to now start off this poll, which will be in front of the audience right now. And it is that, in your opinion, what are the key elements of a good risk management program, right? So is it something that Neil just spoke about? Is it involvement of the senior management of the board of directors and having a top-down approach towards it, and having a compliance function, having continuous staff trainings? Is a third-party due diligence that is of key importance as well? Or is it risk management clauses and agreements with third parties? And or is it testing and auditing of policies and procedures? And of course, is it all of the above, maybe some components of everything? So I do see some people already responding in. I'll just give everyone the next 30 seconds more to respond. And I think one of the key things that Neil spoke about in the last 2 areas, which will resonate with other parts of the discussion as well, is the perpetual review as well, because what is happening today may not be happening tomorrow, and things do keep changing and data keeps changing all the time. And that perpetuity or the continuous reviews is what will bring the real identification of any risk that might be there. So I do see most of you have responded to the poll question. I'm just going to give it another 5 seconds before I end the poll. Okay, and the results should be in front of you. So we do see that majority of the respondents have mentioned that all of the above, meaning all of these things in some capacity or the other, do have an impact, and what the key are the key components of a risk management program. But we do also see that the second highest vote count has gone to having adequate policies and procedures and controls in place as well. So thank you so much for everyone who participated in this poll. It should be away from your screen now, and we'll go back onto the slide deck and start talking about the next area, and which is how to implement. So we've looked at the areas of risk management. We looked at, even though we looked at the UK Bribery Act, but it's more wholesome in nature, and as Neil mentioned during the conversation, it has a wider impact. It shouldn't just be looked at from a bribery aspect, but it can be looked at into various on an overall risk management framework. So now I'll invite Neil to come back and talk about how in his opinion, how to implement this risk management program.
Thanks, Naman. Yeah, so within this, each organization is different, so that there's not really any right or wrong approach. But what we can do is, if you're at the beginning of building a compliance process, we can look at other industries to give us a head start. So, for example, financial institutions, they have a regulatory obligation to have controls, mainly around money laundering, etc. So I think this is a useful place to look as giving us food for thought, because these programs have been in place for over a decade. So they've had to work through a lot of the issues in terms of implementing and keeping the program effective. And a popular approach that we see there is the 3 lines of defense model. And in this approach, we see the main operations teams bearing the majority of the responsibility for the checks. And these teams are usually much closer to either the customer or supplier. And they usually have the ability to obtain information and query things. And because they're closest to the third party, they're often best placed to sniff out if something doesn't seem right. And the second line of defense is the compliance function. And that will typically have the people who will be more involved with understanding the regulations. They'll be the ones that are determining the risk appetite and defining the formal policies and the actual practical approach to putting this in. And again, if we look at financial institutions, there's usually a specific role, like the money laundering reporting officer that sits there. And this line may be consulted in specific circumstances. So it acts more as an escalation point, because really this is where the policy and the reviewing of the processes is supposed to take place. And then right at the top, the third line, this is usually either internal audit teams, or in some instances, it might actually, you might use a consultancy to come in and run an assurance project to look at your program. And really, this is just to make sure there's top oversight and make sure that everything is adequate and it's effective, and puts like an extra layer of quality control. So using this as a bit of a yardstick, you can compare this to your current program. And what really jumps out to me in this model really is the scale of the first line. And that in turn is usually where we see one of the barriers around the training program needed to ensure that that first line is suitably knowledgeable and skilled. So for companies more at the beginning of the journey, typically what we would ask is, who do you think your first line of defense is? And it could well be that those roles don't sit in one function. They could be split across different teams in different locations, which again moves into the importance of communication and training aspects. So it is often quite a big ask to put this in place, especially if you're a larger company in multiple locations. So as an example, if this is looking at, say, supplier due diligence or supply chain, are your category managers or your procurement managers your first line? And if so, where do these report into? Do they have regional or country reporting lines? And often you might not actually have direct management control over them. So these are the sorts of factors that can often hinder getting buy-in from that first line of defense. And then what we see is the temptation to move into a structure that's more like this, where the second line of defense starts to bear the vast majority of the responsibility. And what we normally see, where we see evidence of this, if we take the supplier due diligence again, it could be those category managers or procurement managers saying, well, that's not my job. Compliance isn't my issue. I'm going to pass this over the fence to the second line and say, you need to sort that out. And then what we see is that the entire compliance responsibility starts to fall onto maybe a handful of individuals in the second line. And what we found is some of these programs start to feel a bit squeezed because they've got a first line that isn't really trained and they're not really bought into it. They don't really believe that it's their job to do this. And then often they're constrained as well by senior management that are not necessarily resourcing and giving them the amount of people they need to actually take it on. So this is a common pitfall that we see when compliance programs are being rolled out.
Yeah, and so I think I would say majority of the conversations, Neil, that we do have with clients, and if I may just go back to the previous slide, and so this is where we get to hear this quite often from our clients where this happens. So how does one get away from all of this and to move away from relying on the second line of defense, where using your terms that it's not my job and it's and the business teams usually saying that. How does one tackle this kind of a challenge? Because I think overcoming that mindset is probably going to have that long-term effects on a positive scale from a company's view, isn't it?
Yeah, and I think that's where it comes back to those key principles that really to overcome this, you have to have that senior management buy-in. It needs to come down through their reporting line that this is important and that the business as a whole wants this compliance program to be effective. And I think it's very difficult if you're in a second line and a compliance function, if you don't have that, because then it's difficult to recruit and make that first line feel bought into it. So you really do need, I think, that senior management message to come down to say, you're our first line. Everybody in the business is responsible for making this happen.
Sure. I think, and that's extremely fair. And I think this then very aptly in the next section that we have is for, how do we make strategies for effective risk management, right? And so Neil, over back to you, and maybe this will shed further light around this as well.
Yeah, so I think a common approach we see around due diligence is a periodic review. So typically you'll do a risk assessment on your third party, and you might not revisit that for 1 year, 3 years, 5 years. And obviously a lot of risks can happen in that time. But what we're seeing a big shift definitely in our region is towards perpetual or continuous due diligence, where as soon as risks emerge, companies want to be aware of them immediately. And this has an inherent knock-on effect to what you just mentioned, Nauman, in terms of buy-in, because really we've kind of got a pyramid here of the foundations that are needed to kind of get to this level of automation and monitoring. So first of all, at the bottom, you've got to have a good data strategy. So we've got to understand and reduce the silos of information. And we know that a lot of companies might have some tech baggage around that. So this often can be a challenging area. But really, I would say you've got to think about this at the foundation. And we've seen lots of people try and jump ahead and try and get straight into the top parts of this pyramid. And it always struggles if you haven't got that foundation and data strategy right. And then above that, then policy. I think we saw that in the poll there around having that. Obviously, you have to have one, and it's got to be reasonably clear, and you've got to understand what the business is trying to do. And I would say also spend a lot of time on this as an organization, because if you can make this policy very, very detailed, then it kind of links to the next one, which is workflow. Because if the policy is well written and says, this is what we need to do in these scenarios, these are the checks that we want to do to mitigate risk, then the better job you do on that, the easier it is to start to think about digitizing that policy and putting it into a system. And obviously, if you can put it into a system, you can start to then look at automation. So that has the knock-on effect of, I think, making it easier to get your first line to buy in. Because, yeah, if you basically
guidelines in place, and automation is really going to help the first line of defense to actually buy into it and not look at it more of as a forceful thing, but rather how it merges into the day-to-day activities as well. Sure.
Exactly. If your first line is given a 50-page PDF and saying, here's our policy and here's all the sources, go and get the data and do it, then there's going to be a natural resistance. But obviously, if you can put this into a system and say, well, here you go, the system's going to do the majority of the work for you, then there's less burden on that team. And then this is where it kind of flows into the monitoring aspect, and where we start to get this perpetual nature. Because if you do the first 3 layers well, then really monitoring starts to become easy, because what we would say is look at ways of getting the data in automatically through APIs or data feeds. And as soon as that data changes, all you're really going to do is feed it back through that system. And it doesn't have to be then a really big burden on the first line to keep on top of this. And then really right at the top, I think we have to call out that ultimately we have to accept that no matter how much work we try to put into a system, there's always going to be the need for a team that's going to do some adjudication. There's going to be escalations and decisions that have to be made, and awkward choices. So the aim really is to minimize how much gets to this layer. You want all the obvious decisions to be done by the system. And that way, people have got the time to really consider the risks and really make the right decisions in terms of what's been flagged up. And then one question that we always get when talking to companies around putting a program in is, why don't the regulators and supervisors just tell us what we have to do? So it's a good question, and one that we hear quite often. And the reason for that really is back to those guiding principles, in that the expectation is that that when you put a program in, that you're really trying to achieve the end aims rather than just tick the boxes. And different industries have different risks. There's not really a one-size-fits-all due diligence program. So on screen here, at a very high level, a financial institution's risks are going to be very different from, say, a manufacturer or an exporter. You know, a clothing importer and retailer is likely to be more concerned around, say, forced or slave labor in their supply chain, because that can be disastrous from a reputation point of view. And a manufacturer, if you're dealing with foreign governments or contracts, then bribery and corruption is a risk. And also, depending on where you're supplying, sanctions can be a risk. And a bank is going to be very much worried around the money laundering and the flows. So really, a blanket due diligence tick list just isn't appropriate to all situations. So really, that's why the guidance typically says it's up to you as a business to understand the risks, because otherwise you get drawn into a tick box program. And then if a new risk comes up and you get caught out and something happens, then we don't want that answer of, well, it wasn't a question on the list, so I didn't think it was a problem. What they're really looking for is that people have that kind of culture of saying we're actively looking at risks. And I've just put a table on the screen. Obviously, we won't go through this. We don't have time to talk through it. But this table does actually exist in an ebook that D&B have produced around how to create an effective third-party risk management policy. So yeah, rather than me reading through this, if you are interested, we can make that ebook available to you.
Absolutely. So if I may just stay back on that slide and maybe try and, there's a question, Neil, and maybe you'll be able to see it as well in the Q&A window. I'll read it out for the audience while you're clicking through that as well. And since it relates to this part of our discussion, I felt we could maybe pause here, answer that question, and maybe others who are on the call may benefit from that as well. And the question from Vivian is that knowing that the first line of defense of what we've covered earlier should be buying into regulatory assets, contracts, and litigation compliances, kindly expand on the risk strategies that businesses can put in place. Also, share experiences you have with some of the businesses you have implemented these strategies in. Would you like to take a crack at that, Neil?
Yeah, and I think it touches back on a couple of the bits we just mentioned there. In the program has to be well resourced. I think that's probably one of the biggest issues we see. So really do need those senior managers to give you the resources around pushing that in, because going back, it depends on how you're structured. If you're lucky and you are very close to your first line and it's kind of one organizational unit, then it's a little easier. If it's not and it's scattered, then really it's all around that training and buy-in and making it as easy as possible for that first line to take this on. If you turn up and say, here's a big burden and a big job I'm going to give you, then it's going to be very, very difficult. So I think that the strategies that we try to advocate is try to take a bit of a tech approach, try to put a system in that takes the heavy lifting off them. And if you know what your policy is and you can digitize it, then don't make the first line have to understand a 50-page PDF, but have them bought in, really. So I can't actually see the question. I'll have to find it, but hopefully.
But you have covered it, and I think that goes, and we had in our expansion on that slide, and what we're talking about was, and maybe I'll just go back to it for the benefit of Vivian as well, right? And this is what we were talking about, and Neil just stressed on, is that not having just a 50-page document being sent to your first line of defense, that this could be a sales team member or a supply chain officer or a procurement team, whoever is in the front, depending on which use case of risk you're looking at, but rather making it more actionable, make it more easier for those first line of defense to be able to take it ahead and make it as simple for them to make it stepwise, so they can replicate those actions as well. And wherever possible, as Neil mentioned, digitize it, and that would make everybody's life easier to be able to not just record it, but we will be able to see similarities of the various risk and issues that keep popping up again and again. So that eventually could help, that kind of data set could help make an evolution of a risk ecosystem as well, and the kind of counterparties that you're dealing with. So we do have another question, Neil, and thank you for the response to that. I was hoping that you could see the question, but that's okay. I'll read that out loud as well for you. The second question that we have, again on the same topic, is what about the disruption of logistics supplies, and under which strategy can we cover it?
Yeah, so I think that's quite a difficult one, because to start to monitor that, one of the biggest challenges we see with our clients is just actually understanding what your supply chain is. So it's very hard to know where disruption can happen if you start to lose visibility. So I think that's one of the trickiest areas. But yeah, we deal with quite a few clients, and there's a very big difference in the maturity, to be totally honest. Some have visibility of their supply chain all the way through to, say, farmers in Africa. You know, they really have gone through every single step, and others have struggled to get past maybe tier 2, tier 3 suppliers. So I think the first challenge is really understanding what the supply chain is. And then once you've done that, then you can start to look at different aspects. So the actual financial health of those suppliers, as well as some of the other disruptions that you called out earlier, Nauman, like when the the ship got stuck in the canal, then who's got containers on it, and there are other feeds that can kind of give you things like potential weather disruptions, natural disasters, and if then that you've got suppliers in well, maybe I'll pick Florida since they're about to be hit by a big storm. If you know that certain parts of your components and supply chain are ultimately coming through some American companies and through Florida, then you could start to say, okay, well, what are we going to do about that, and what mitigation can we put in place? But it's not easy. it's a big task.
So I think I would just like to add in there, Neil, and thank you for that response. And I hope your name is not visible for the person who's asked that question. But I hope this answers the area. But I would like to focus on another part and something that Neil also spoke about. I think it's the data that goes into and that awareness of what's happening around. So having the right data points, be it climate implication that may be there, or going up to the nth level supply chain, supplier as well, and not just stopping at the one person that you deal with, but going to the chain as well. That is where a lot of data suppliers and the organizations will come in, and where companies need to open up and to be able to invest into understanding the complete supply chain to the nth level. And data organizations such as Dun Bradstreet have been working with our clients all around the world, including Middle East, Africa, and South Asia as well, and of course other Western mature markets, to be able to help understand all of this. And once you know who you're looking at, the ability to be able to identify risk, be it administrative, be it logistical, be it weather condition wise, all of that becomes easier to be able to manage and to look at. So I think that's something I want to dive into as well, because that also links into how Dun & Bradstreet is helping and facilitating our businesses. So just to sum up here on this area, right? So what we're talking about is maybe reduced risk of fines and penalties, and adherence to regulations and standards can help organizations avoid costly legal consequences, right? And enhanced reputation, such as a strong compliance and risk management program, can help improve an organization's reputation and trust with the stakeholders that it's working with. And that directly now then links into improved operational efficiency of effective risk management, can help identify and address those issues before they become major problems, right? Like Neil mentioned, so we can see and hear news that something is going to happen in Florida because of a climate condition. How is that going to have an impact, right? So keep following those kind of ideas there. And then, of course, that eventually by having all of these good strategies and effective risk management in place, we're looking at increased customer and stakeholder satisfaction at the end of the day, where the focus is on compliance and risk management, and your clients and your stakeholders are satisfied, right? So that's going to lead me to our next and our second last poll of the day. And I am conscious of the time, because we do have a limited time to close this off. And the poll, which will be on your screen now for the audience, is: what is the most important or significant risk your organization has faced in the last 12 months? Is it cybersecurity? Is it supply chain? Is it regulatory? Is it financial instability? Or is it something that we have not covered here? Again, the chat window is open. Wherever you're comfortable, in the chat window or in the Q&A box, please put in your questions or raise your hand for yourself to be unmuted by us, and you could talk to us live as well. I'll give you another, quite a few people have responded already, maybe another 10 seconds for you to respond. I can see that majority of you have already responded. So I'm going to stop the poll there in the interest of time and share the results on the screen with yourselves. And we can see that there's a mix of responses there. Neil, as you can see, it's an interesting response where it's being led by regulatory change and followed by financial instability. And then it goes into others which we haven't covered, but supply chain disruption and cybersecurity. So there's a wide mix of risks that companies are facing all the time. and having active and evolving policy framework in place and the strategies that we've spoken about in the webinar so far. We hope that that has been useful for you. And we can, of course, we can continue these conversations post this webinar as well. If you're interested to have a more deeper conversation around any key element, of course, we would be there to help and support wherever possible as well. So let me now go into the next section, and we've covered the major part. What we're trying to talk about now is one of the platforms that Dun Bradstreet offers, and this is called Risk Analytics Compliance Intelligence. And this is a newer, let's say, a SaaS platform that Dun Bradstreet has launched, and it dives directly into the theme and connects into the theme of what Neil and I have been speaking about in the last 45 minutes, and that is about ongoing KYC and monitoring. And at the heart, this is what it does, and takes advantage of Dun & Bradstreet's core strengths of having offices in over 100 countries worldwide to ensure that we are picking up on the right data at the right time, so that you as customers or people who are using this information are aware of the updates all the time. And this is one of the core fundamentals and the differentiating factors of these platform that we have developed. And clients are taking advantage of this as we've launched it a couple of months back. And so it is, the continuous monitoring and the act on the inside of the audit or providing material information. So at the end of the day, it is touching less records, right? And only working on the most riskiest or the most relevant activity that needs your attention at the end of the day, because there'll be a lot going on. So how do you pick up all of those things? And that starts with, and I'm going to go to the next slide, which is the system and the engine runs on a policy-led risk mitigation framework, right? So you define the policy right in the beginning, what impacts you as an organization based on your risk policy. So is it the countries that you're working with? So you could define higher risk to certain territories or countries. Is it the counterparty's line of business? And that counterparty could be a supplier, a vendor, a client, or a business partner. Who is giving you the highest amount of risk and what line of business? So you can define risk policies from there, and then continuously use this policy to keep changing it based on the output which are coming in, and dives back into the policy the monitoring of these changes as well, where you can plug in that what changes within the third party should I be notified on, because you can't look at all counterparties all the time, especially where manufacturing or export-import clients are using our services. It would become a little difficult for them to look at all hits and all alerts all the time. So if you make a comprehensive policy, adopt it into a platform such as what Dun & Bradstreet provides, which is called Risk Analytics Compliance Intelligence, you will actually only focus on areas which are going to need your most amount of attention at the end of the day. So it reduces your due diligence outreaches, it streamlines your reporting ecosystem, and it verifies entities faster as well. I know I'm stripping to this a little quickly because I am conscious of the time. We just have under 2 minutes to go for the webinar. And I'm just going to dive into two very quickly, some case wins in our local markets. We have an aircraft leasing organization which has been looking at this kind of they had a policy in place, they were evolving a policy, and they're now utilizing Dun & Bradstreet's ecosystem to be able to have the legal processes and the policies in place to ensure that they're only looking at the key issues that are in place and are being presented. Similarly, we do have a global example such as Siemens, who in 2006 had major corruption scandals, which resulted in almost a $2 billion fine in 2008. So they have been working with us on a continuous basis, and they have also worked with us, and they're continuously working with us on this as well. And our platforms are helping Siemens to focus on high risk companies that they're working with, right? And so that's something I want to cover quickly. And we do always also have this QR code that you can scan and look at. And if you want to download this product brochure, you can look at that as well. Neil, we do have some other questions, and this is where the main content obviously ends as well. And we do have some questions too on screen. So I'm just going to start the poll and as well, so that people can answer that in the interest of time. While also try and answer the questions that are there on the screen in front of me. So one of the questions is, Neil, that with the ever-evolving threats, the due diligence changes every few years. So do you suggest that companies should revisit their risk strategies in regular intervals? So that's the first question that's there. I think a great question to ask.
Yeah, I mean, I think the quick answer is yes. I mean, in some respects, depending which industry you're in, you're kind of forced to. I mean, if we pick the AML and KYC industries that threats, then as new risk typologies emerge, then often they're wrapped into new rounds of regulation. So in the UK, real estate, even art dealers now, because they found that money launderers were using art to move high value goods. As they find these areas, then they typically try and tighten up on them. So I think the quick answer is yes. Is part of the program is continually to look and say, are we exposed to something new happened?
Great. And so I'm just going to stop the screen share now, and so maybe both our faces are visible to the audience together. And the last question that we have is that, can you elaborate on how supply chain risk is linked to regulators and regulatory issues?
Yeah, I mean, I'll answer this probably more from a, say, UK European perspective. I mean, effectively, it's now becoming regulatory. So yeah, in Europe, we've got CSRD, which was about you have to report on certain metrics about your sustainability. But that CSDD, the triple D stands for due diligence. You're now obligated to do due diligence through that supply chain. So it's no longer a best practice and we don't want to have a scandal. In Europe, it's moving that way of saying, okay, corporations have started to put their own programs in place, but it's starting to get more solidified into actual regulations. It might take a little while for that to kind of move all around the regions, but effectively just using Europe maybe as a first mover, we're seeing it move into regulations now and away from the right thing to do.
Yeah, great. Thank you so much for all the questions, everyone. There is just a comment there in the chat window where the presentation slides we shared with participants. Yes, we will share it with you. And I'm not taking your name specifically, but because you asked it to us directly, of course, the recording and the slides will be available. Neil, we do have another question there. And since people are still logged in, maybe we could take this as well. So the question is, does risk analytics benefit companies of all sizes? So maybe I'll answer that, and maybe you can jump in as well wherever needed. So yes, I think from our experience, since your name is not that I can't address you by your name, but yes, risk analytics is a wider SaaS-based platform or web-based platform. It is not just focused on large organizations. It is for businesses of every size. And we are in conversation across South Asia, Middle East, and Africa with all type of companies. And these are younger organizations who have started the operations 2-3 years ago, some who have done joint ventures now and setting up their ecosystems, that they're setting up the risk policies. We've looked at, we're working with very large and established organizations as well. So it's a mix of every one, and we see that our clients are taking benefit of these platforms irrespective of the size of their operations. The idea is that you need to be aware of the counterparties that you're working with and the risk elements around that. So that means KYC, due diligence, operational details, firmographic details, ownership details and insights, corporate linkage insights, and to be able to run compliance screening wherever needed for sanctions and compliance and watch list and looking at adverse media articles. I think we feel that these kind of risks that are carried are applicable to younger organizations or startups as well as very established organizations as well. So those risks apply to everyone, and especially if you're in a cross-border business ecosystem, then having these kind of platforms available to you should really help.
Yeah, I'll just add to that now, and just quickly that although D&B has built it, in reality, it's our customers that built it. To be honest, it was spending time with them and just listening to how they were putting their programs in. That it really was built almost entirely off client feedback of saying, this is what we need out of a system, this is what our program's trying to achieve. And I think it's been really popular with the smaller businesses because, like you said, we've tried to cover a lot of the risk typologies in one place. So if someone doesn't have a program in place, it really jump starts them really quickly. And obviously we designed it with the maximum amount of automation that we could squeeze out of it. The whole concept was, in an ideal world, we wanted the user just to have to click one button, which is start the evaluation. And if everything's good, the system can just process it all the way through to a green result. So that was very much like the design principle behind it, of automate as much as possible.
Sure. Thank you for that, Neil. And that really ties into the fact that we are driven by what our clients say and what our clients demand at the end of the day. And all these evolutions have happened because of that. While it is not, this question is not available in the chat window and otherwise, but because this webinar is being streamed on LinkedIn Live, there is a question that has come there. And the question there is that, can you provide a few insights into what indicators will be available on Risk Analytics Compliance Dashboard? So the kind of indicators that one can see or one will see would be, first of all the businesses that you're actively looking at. This could be your vendors, suppliers, your third parties that you're working with. So it starts with that and shows you a listing around who you've been working with. Then it shows the riskiest third parties in your ecosystem who are giving you the highest amount of risk. And that kind of risk will be based on the policy that you've set into the ecosystem. And so what I'm going to do is, for the benefit of the audience, maybe I'll share my screen and so that you can see what I'm saying in action as well. And it should be on everyone's screen now. Neil, if you could just confirm from your end as well, if you could see the RACI screen.
Yeah, that's visible now.
Yeah. Okay, so great, thank you for that confirmation. So as you can see, you're able to then see the final risk that you see here, the scoring that's available, that is based on the policy that you've set into our platform and the weightages that you've assigned for every risk key element. So meaning that, for example, a politically exposed hit is something that's of a highest risk, and maybe a sanctions list is a low risk. I'm just taking a wild example here. So that will define, and you can assign weightages, and that will define what is the kind of final score that could be assigned to a counterparty. So this it leads you to that kind of scoring. Then it also shows you the third party status. That means that how many companies have you reviewed, how many companies are still remaining on an overall. So Dun Bradstreet gives a lot of predictive scores analysis as well, and descriptive scores too, out of which 2 of them are visible on the screen as we can see. One is an OBR, or the overall business risk, based on all the elements that Dun Bradstreet is covering, and there is a failure score as well. So you can toggle between the two, and our clients are able to see what are the risks that are there and how many counterparties are there in my portfolio, or the ones that I'm reviewing who are connected to me, who are the ones who are giving me the highest amount of risk. As I've done the mouse over, you can see there are about 27 businesses in my portfolio as an example who are giving me the highest amount of risk. I can work with them more, I can engage with them more, and there is a continuous monitoring that's happening at the back for perpetual KYC. So it's continuously advising you what's happening as well. So if you see here on the top right, there's a bell icon there, and as you can see, there is a complete updates which are happening all the time, and you can go and look at those as well. Right, and you can of course also look at, we do also cover environmental, social, and governance. We are the largest provider in the private data company ecosystem to give you this kind of output as well. And our customers are able to see both all three environmental, social, and governance outputs as well of the counterparties that they're work with, and to understand the carbon emissions, to understand sustainability, and to who and who not to work with, and to work on an ESG improvement program as well with third parties. And of course, in certain markets, we do also cover cyber risk ecosystem, and so that is covered as well. So this is something that I just want to show based on that question, and that's a great question that has been asked. So just want to show that. And with that, Neil, we do not have any other questions either on the live. I can see there is no other question here. I cannot see any other question or comment on the chat window. And lastly, I cannot see any other question in the Q&A box as well. So great. So with this, let me take the opportunity to thank Neil, first of all, for taking up time to join this webinar to talk about a very important topic and share his experience and insights into risk management and the strategies. And we hope that all of you who've joined in, thank you so much for taking the time to join either on LinkedIn Live or registering for this event over Zoom and participating over Zoom. I can see most of you are still part of the attendees, even though we've short over time. And it just shows the kind of interest that's there. So thank you, Neil. Thank you to the audience. And we will see you again in the next webinar hosted by Dun Bradstreet, South Asia, Middle East, and Africa. Thank you once again, and have a great rest of the day.